What happens to oil prices when the drums of war echo through the Middle East, specifically between Iran and Israel? This is not a hypothetical question but the reality we observed recently. In the immediate aftermath of the reported attacks by Iran on Israel, the oil markets were quick to respond. Brent crude, a major trading classification of sweet light crude oil, saw an approximate 4% increase shortly after the news broke. This swift uptick was a clear testament to the market's keen sensitivity to geopolitical disturbances in the Middle East, an area that holds significant sway over global oil production. However, the immediate market reaction was just the tip of the iceberg. There were growing concerns about Iran's oil infrastructure potentially becoming a target in the conflict. Any direct conflict that results in the destruction of Iranian oil facilities and exports would severely disrupt supply. This could drive global oil prices up considerably, as pointed out by market analysts. The ripple effects of this conflict reached Asian markets as well. The fear of supply disruptions and the likely increase in oil prices led to Asian refiners bracing for the impact. Despite the potential instability, there is a cushion due to the ample supply from Russia and other exporters outside the Persian Gulf region. Market sentiment and speculation also played significant roles in shaping the oil market's dynamics. Prices have a tendency to spike during times of heightened tensions and uncertainties. These price movements reflect not only the reaction to current events, but also speculation about possible future disruptions and escalations. The conflict also triggered a classic risk aversion response in broader financial markets. This involved a reversal in U.S. equities and a slight decrease in bond yields, indicating that investors were moving towards safer assets. Such shifts often accompany increases in oil prices during geopolitical crises, underlining the interconnected nature of global markets and the pivotal role of Middle Eastern oil in economic stability. In the long term, the conflict could lead to sustained high prices if the situation remains unresolved or escalates further. This is particularly critical given the strategic importance of the region in terms of global energy supplies and the potential for further disruptions or attacks on oil infrastructure. In conclusion, the recent escalation between Iran and Israel serves as a stark reminder of how quickly geopolitical tensions can translate into economic impacts, particularly in the oil market. The potential for further increases in oil prices hinges on developments in the conflict, the international community's response, and the extent of disruptions to oil supplies. As the situation continues to unfold, markets remain on high alert, with stakeholders closely monitoring any changes that could influence global oil supply and prices. So, next time you see headlines about conflicts in the Middle East, remember it's not just about politics or military strategy. It's also about the price you pay at the gas pump.